Hey everyone, welcome back to Corporate Decoder. Today we are diving into W.R. Berkley Corporation's latest 10Q report. And trust me, it's not just another stack of papers. It's like trying to predict the weather. But instead of rain, we are forecasting profits and potential pitfalls. And I've got a few surprises for you. Berkley CORP, one of the big players in the insurance world, gives us a peek under the hood at their first quarter. We'll uncover if their strategies are hitting the mark or if storm clouds are gathering. And remember, if you find these corporate deep dives helpful, be sure to like and subscribe. There's also a Discord community linked in the description below. Alright, let's get into it. First things first, this is our Form 10Q, basically a quarterly checkup for publicly traded companies like W.R. Berkley Corporation. It gives investors a snapshot of how they're doing. The report covers the period ending March 31, 2025. Let's start with a glance at their balance sheet. Total assets, a cool $41.30. What's more interesting is compared to last year, they bumped up investments quite a bit, mostly in fixed income. It's like moving your money from a savings account to bonds, a slightly safer bet in uncertain times. Now, something you always keep an eye on with insurance companies is their reserves. These are funds set aside to pay future claims. Berkley's reserves are at $20.9 billion, which means they are preparing for potential payouts. Now for the good stuff, their income statement. Net premiums earned, a key revenue source for insurers, hits $3 billion. They also made some money in investments, but let's cut to the chase. What's the bottom line? Net income is $41.1750 million and loss expenses, which tells us they paid out more claims. Urge gives us about 1.04 this quarter. It's down a bit from last year. The main reason for the dip is a big jump in losses and loss expenses, which tells us they paid out more claims. There is another number that gives us a better picture called comprehensive income, including unrealized profits. That's up compared to last year, but most of it isn't cold hard cash, which means the value of their holding increased. Now, the shareholders' equity is at about $8.9 billion, so these are the raw numbers, as you can see. The balance sheet is mostly stable. Income dipped a little due to more claim payouts, but we need to compare it to see if it's actually good or not. A quick thing to note about earnings per share, or EPS, the weighted number of shares they used to calculate the amounts changed. This is due to stock incentive plans. This just means that there are more shares on the table, so that number changes over time. In fact, they repurchased almost 500,000 stocks. The income tax section tells us they will follow new transparency rules, which requires improvements to income tax disclosures, primarily related to the rate reconciliation and income taxes paid. Now, the company has to report what they call accumulated other comprehensive income loss. This is essentially a summary of accounting math that is not cold hard cash, one portion of which is foreign currency value increases or decreases and securities values increases and decreases. It gives a better, more rounded picture of the assets that they have. Cash flows gives us an interesting picture. They made a lot of cash from operating activities, over $700 million, but they spent over $900 million in investments. They also used about $80 million in financing, which means that they use that money for activities such as paying dividends and buying company stocks. The fair value measurement section goes over how the company figures out how much their stuff is worth by using all sort of data, and divides that into three broad categories depending on how reliable that information is. To level 1 is basically stuff that has a market that can be immediately converted to cash. Level 2 is stuff that other people have that looks close to ours, and level 3 we are making our best guesstimate. The higher the level, the more reliable the source. Here's where things get a little bit interesting. It's about the investments where they are underwater, meaning they'd lose money if they sold them right now. The good news is that most of the unrealized losses are due to temporary market issues, not because the companies they invested in are doing badly. So they're not sweating it and think those investments will bounce back. But also they have to recognize that some bonds had credit issues that can't be ignored. There are other more common sections like statements of cash flow, but they are standard, and everything we mentioned so far are more unique to an insurance corp such as this, so we skip those. The next portion goes into the details of all insurance deals, including what they earned, assumed, and ceded. The written premiums were in excess of $3 billion, which is great news as it shows the company is writing insurance and bringing money. They also issued 20k RSUs that vest in 3 to 5 years. This means giving out a promise for shares in the future, which is used to retain talent. Now let's talk lawsuits which they have, but they believe the outcome will not be significant, although it is noted that the outcome could be material. Now, finally, let's review the safe harbor statement. All companies need this statement because we discussed expectations for the future. Additionally, there has been no change to internal controls, which the CEO and CFO certified to Clicky. So what's the final verdict? Well, let's wrap it up. Looking at these numbers, WR Berkley shows a mixed bag. While revenue generation is strong, profitability is under pressure. A key area to watch will be how they manage their rising claim expenses, especially against increases of social inflation for cars. Also, while those investments lost value at the moment, they expect it to stabilize and turn around. If claim trends continue upwards, it could impact future earnings and potentially require a review of their premium rates. Ultimately, a key challenge to watch out for Tender what he is under pressure. A key area to watch will be how they manage their rising claim expenses, especially against increasing cases of social inflation for cars. Also, while those investments lost value at the moment, they expect it to stabilize and turn around. And if claim trends continue upwards, it could impact future earnings and potentially require a review of their premium rates. Ultimately, a key challenge to watch it. What do you think about these results for WR?